Hello, my name is Malcolm Skinner and I'm a solicitor in the LexisNexis Private Client PSL team. Today I'm joined by Jacqui Lazare, a solicitor with Royds Withy King, and we're going to discuss tax effective giving to charities. Welcome, Jacqui.
Thank you.
It's almost axiomatic, surely, that tax effective giving is a no-brainer when it comes to charities. They attract large numbers of tax reliefs anyway, don't they?
Yeah, that's absolutely right. And I think it would be fair to say that the most common approach with giving money to charity focuses on maximising the income to that charity. What I would like to focus on a little bit more today, or highlight, would be a more strategic approach that you could take when advising a potential donor and what might be in their best interests and what might suit their giving. There are a number of reliefs, like you say, that are out there. Some maximise the relief going to charity, some maximise the relief to the donor. So for example, gift aid will maximise the income to the charity at no cost to the donor. But all reliefs are designed to encourage giving, and they all help generate additional income for the sector. I think what would be really what's really important for advisors to focus on is making sure they're aware of their clients' overall estate planning requirements or tax planning requirements, and recognising that philanthropists will have multiple drivers for their giving. So it's just, again, looking at the overall picture for that client.
All that sounds very good, if a bit cynical, perhaps?
Yeah, a little bit, absolutely. But I think making sure you're remembering that all these reliefs are available for the benefit of the sector. So for example, maybe prompting a gift that might not otherwise have been made. There's still a gift. This is just a bonus in addition to it. And I think it's possible for some of these other reliefs to be overlooked. I think one thing I'm most aware of is that it's not uncommon for a client or a donor to be referred to me where they've been advised by another professional advisor, where they have an asset that's inherent with gain. Great idea, transfer it to a charity, it will be exempt from capital gains tax relief, super. But sometimes the concurrent income tax relief is overlooked, and that goes directly into the client's pocket. So yeah.
Yes, okay, so generally, what would your advice be? You have a client, he wants to give to a charity. Where do we go from there?
Looking at all of the available tax reliefs, and particularly looking at the client's overall estate planning or assets that they have. So for example, if they have an asset that's pregnant with gain or inherent with gains, or if they have an inheritance tax liability that's looming ahead of them, then that's a good starting point.
Okay, to the nitty gritty then, what are the reliefs, the main reliefs that are available?
I think the ones, there are a number, so for example gift aid, there are some regarding social investment tax relief, things like that. The ones I would like to focus on today would be relating to gifts of listed shares and securities, gifts of land, and also gifts or looking at estate planning, for example, the ability to reduce the inheritance tax liability on death, something like that.
Okay, well let's boil that down or dig down a little deeper onto that, and particularly on the listed shares and securities point. Where do we go with that?
Yeah, I'm very conscious it's not exactly breaking news. It was introduced back in back in 2000 with the Finance Act. But the full value of the shares being transferred to charity is exempt from capital gains tax. In addition to that, the full value of those shares is also deductible from the donor's income in that tax year, which can present an incredibly good form of income tax relief, as I say, in the donor's pocket. It's available to both individuals and corporate donors, so from companies considering CSR policies and so on. In their case, of course, it will be deductible from the value of the transfer is deductible from their profits rather than their income. As with many reliefs, if there is any benefit retained by the donor, then that is going to reduce the value of the tax relief that's going to be in their hands, but yeah.
Okay, so how does this compare with what one might always consider to be the first stage, which is gift aiding, the proceeds of sale of the shares?
Yeah, here the value of the gift is going to be less to the charity. So they'll get the bulk of the gift, but it's not going to be increased by any tax relief for them. Here, the donor is the one who ends up benefiting, and that's the key difference, really.
So we're looking at the donor, how he can benefit rather than necessarily the charity.
Yeah, absolutely.
So I'm sure you've got many cases where you've been involved with securing this sort of release. Perhaps you could give us an example.
Yeah, my favourite example is not actually mine. It's my colleague's, but she was involved in advising a client a short while ago where it involved a very high value transfer of shares, just over £1 million, and in this case the client was one half of the owner of a well-known listed interior design company. They were looking to wind down their involvement in the company and were already planning to sell their shares back to the company using the proceeds to set up a charitable trust. So all well and good. What we advised, or what my colleague advised, was to in fact set up the charitable trust and transfer those shares in specie to that charitable trust. That transfer will have been exempt from capital gains tax purposes. The value of that transfer, like I say, over £1 million, was completely deductible from his income for income tax purposes. In addition, the charity was then able to sell the shares back to the original company. Again, the capital gains tax relief applied. So it was just a super result.
Well, I'm pretty sure I can guess, but how did the client take that?
The client was thrilled. And in this case, it was a great example also of being able to spread that or split that tax relief across 2 tax years as well. So he had 2 full years of income tax-free income, and the charity was funded at a much lower cost than he anticipated. So whilst the original planning wasn't necessarily tax driven, and of course that's what we're focusing on, but although it wasn't, it was still a fantastic outcome and a great example of how these reliefs can be utilised to everyone's benefit, really.
What about other examples where this kind of planning might be apposite?
Yeah, I think possibly more common or more day-to-day would be in administration of estates. If you have residual charity beneficiaries who are receiving shares, for example, as part of the estate, then it is prudent for the executors to try and make sure that those shares are appropriated to the charity to ensure that capital gains tax relief can be secured.
Okay. Well, all these things look good, sound good, probably are quite good, but there's always a but. What about downsides and restrictions?
I don't think there are any real downsides, but yes, of course, there are some restrictions in place, and they're there to prevent the rules being abused. And they are not going to affect people who are using the reliefs properly or following the rules properly. An example of one of the restrictions, I can't remember them all or recite them all,
No,
but an example of one of the restrictions would be where if you have somebody who's owned shares for say less than 4 years, you've got to make sure that you haven't you've declared the true acquisition cost and not fudged that at all.
Okay, all right. Well, the second relief is slightly out of order to the way you mentioned, but I'm going to go for it anyway. Was reduced rate of inheritance tax. Take us through that a bit.
Yeah, absolutely. Again, it's not breaking news, and in fact, I think it was introduced with I think it'd be fair to say with quite a bit of fanfare back in 2012. So to recap, it enables a donor to secure a discounted rate of inheritance tax against their estate, where they leave 10% of their estate to charity, or at least 10% of their estate to charity. What I think is important when it comes to advising clients about this relief is that there are certain tipping points, I think it'd be fair to say, that can really trigger or spur a donor on to actually sign up to try and secure this relief. So for example, the tipping point would be, let's say you have a client who's already inclined to give about, say, up to 4%, possibly 6% of their estate to charity. Then the quirk of the calculation means that if they increase that gift to 10%, their non-exempt beneficiaries, so their ultimate beneficiaries who aren't charities, don't receive anything less, and in some cases may receive a little bit more as a result of the way the relief works. It's a good tipping point.
Okay, that sounds like everybody's getting a slice of the cake here. It sounds much too good to be true. So how is this actually achieved?
Well, the calculation is hideous. It is hideous.
Right,
There are,
okay.
and so I'm not going to take you through the calculation. And there are calculators on the revenue website and so on. But I think what is very helpful when discussing it with clients, especially so you don't get too lost in the detail, is that there are a number of well-known, well-worked examples out there that illustrate to a slightly higher level, but illustrate very well the principles of these tipping points, and in all other respects how the secured reduced rate of inheritance tax will apply to that person's estate. And so I do often rely on these examples to help illustrate the point to clients, and it can be really helpful.
We're lawyers, not mathematicians.
I'm not a mathematician, no.
So how popular is this approach when you talk to clients about it?
To be honest, in my experience, I've had a fairly mixed response, in the sense that yes, there's usually quite a good deal of interest, and then we go through the figures, and then people might call off a little bit more. What I would say is, and again, this is just in my experience, is that coming back to looking at multiple drivers for people when they're looking at tax effective giving, is that here there isn't an overriding concern necessarily to maximise the amount going to charity. So if they are going to want to try to secure the reduced rate of inheritance tax, it will usually be because they are very persuaded by the effect of the tipping point. I suppose what follows is that actually most of the clients that I see that do take this up would often not have children, for example. So their ultimate beneficiaries, yes, they might end up getting a little bit less because of the gift to charity, or a gift to charity, but it's not their actual blood, which can be quite important. So I think being able to highlight the possibility of, if they're already inclined to make a gift, being able to highlight the possibility that this gift could be increased, could secure this additional benefit, is really important. And if nothing else, often pointing out that, of course, you're reducing what the revenue get, it's quite appealing.
We probably shouldn't say things like that. Perhaps we should. Okay. The last relief perhaps we need to talk about is not a common one, but the relief for land passed on to charities. Yeah. How does that work?
Yeah, you're right, it's not so common. But like the gifts of listed shares and securities, it's been around for some time, since 2002. It's very, very similar. So the donor is able to secure a capital gains tax relief on the full value of the land transferred. The donor is able to deduct the full value of the transfer from their income for that year. So that is another big draw. It is different in the sense that you can only transfer the whole of a title of a piece of land. Sure. So you wouldn't be able to split anything across 2 tax years. It's important to make sure that other practical points, like make sure there's a written evidence of a receipt from the charity, they're accepting the gift and deducting any costs or expenses incurred and so on, making a note of any benefits, that all has to be declared. So all of those elements still need to be taken care of. But I think the key tip I would mention is that if you do have a client who has some land where they're not really using it, it may not even be income producing, for example, or it's nominal, then this can be a very useful way of disposing of an asset. You're securing the capital gains tax relief, and you're also making sure that the capital gains tax allowances for that client aren't being used up unnecessarily.
The problem I can see there is that, particularly for the smaller charities, they would be very wary of accepting land. Is that borne out by facts?
Yeah, I think that is fair to say. Charities can often, understandably, be reluctant to accept gifts of land. When you're dealing with land, it does bring additional responsibility, and this is going to be one of the reasons why they might say no. Additional responsibility and costs in dealing with a disposal. It is open to the donor to declare that the land is held on trust for the charity. Right. That can be quite appealing sometimes, and then the donor can then deal with the disposal. That would have to be at the cost of the charity would have to meet that cost. But then the process proceeds can then be transferred afterwards. The only thing then to remember is that, of course, those proceeds can't be gift aided because they're already going to be the subject of other reliefs. So you're not going to be able to do that as well. I think here, although yes, charities can be reluctant, if the key factor for a client in this case is securing capital gains tax relief and income tax relief, for example, then the charity might be at greater risk if they refuse the gift rather than accepting it. So it's recognising all those factors and taking them all into account. I think that's really important.
Okay, so we've been through the reliefs. In conclusion, what would your advice be when advisors are faced with a situation where they have clients who want to do some tax effective gifting?
I think looking at the donor's overall aims, trying to establish what's in their best interests overall rather than focusing on just that one particular transaction. A lot of it will come down to the maths. So what's the maths? So what is the most efficient thing for the client to do, and making sure it's in line with their aims. Timings are going to be very relevant. So for example, looking at a particular tax year, and remembering that no one relief is better than another. Obviously, it will be different for fundraisers of charities, but even in their case, all of these reliefs are designed to boost income for the sector and generate additional giving. And if they are achieving that, then it's a good thing all round.
Excellent. Well, Jacqui, thank you very much. Very interesting. Lovely to see you again.
Pleasure. Thanks, Malcolm.